We haven't seen this type of volatility and this type of fear and this type of distrust and need for liquidity. It's worse than 9/11. It's worse than 2008. It's worse than 1987. So notwithstanding what isn't making the headlines, what's percolating beneath and below the ice of the bond market is a lot of distrust, a lack of faith.
Here at Liberty in Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson with Liberty in Finance. And back with us today is our good friend Matthew Piepenburg from Matterhorn Asset Management. Matthew, thank you so much for joining us today.
Always good to be here, Elijah. Looking forward.
I wanted to ask you about what we've been seeing in the banking system. Obviously, there's a whole lot of topics to discuss, but the bond market is tied into this as well, which you've been talking about for a while, and your latest article is about the bond market. So can you give us kind of a broad view of what you're seeing happening in the financial system right now? It seems like a lot of earthquakes going on right now.
Yeah, I think obviously the banking crisis headlines in the regional banks in particular, which is the most hardest hit, the most vulnerable, as we've talked about many, many times in the past, the banking crisis is just another symptom of a bond crisis. There's been so many cracks in the ice in the bond markets, and the big ones were the repo market disaster in 2019, then the sovereign bond crashed when the S&P crashed in March of 2020. That was a correlated stock and bond disaster. And then, of course, the gilt implosion in the UK at the end of last year. And then, of course, this year we have these regional banks under stress because of the massive amount of duration risk on their longer term treasuries, which were collateral or security for their otherwise difficult loan books. So all of these things are tied together because bonds have been going down in prices, interest rates have been going up at central banks, and so especially at the Fed. So these decisions and these debates at a theoretical level, QT versus QE, rate hikes versus rate reductions, pauses, but these rate hikes have real-term, real-time, genuine on the main street consequences, of which what happened in Northern California at Silvergate or at Signature, of course, SVB. These are all just more cracks in the ice. As Powell joked the other day, it's like walking through a powder keg with a candle. Something's going to break or burst or blow up. And what happened at Silvergate and SVB, et cetera, were just, to me, not necessarily symptoms of a banking crisis, but symptoms of a bond crisis. And I think even more interesting, and it gets esoteric, it gets so it can get confusing, but it actually is interesting to see how important the bond market is to our lives and to our currencies and to our social cohesion and fracturing. And things is boring to many investors, and I understand, looking at Eurodollar futures or looking at the volatility in the 2-year yield or the 2-year futures contract or even the 4-week T-bill. But what happened post SVB in the bond market, I think, is a bigger headline in many ways than what happened during the bank run. Yes, it was a bank run, but it was really a lack of faith in collateral, a lack of faith in a lot of things, including technology as a platform and technology-based loans and collateral. But when you look, for example, at the Eurodollar futures, the price of the Eurodollar future went up 70 basis points. That was worse. That's twice as bad as when we saw during the Lehman crisis. And what those Eurodollar futures are is it's a bet on the market that there's going to be lower rates in the next 6 to 12 months, depending on what your contract is. Well, what that means is the market is expecting some type of rate reduction. And the only reason they would expect a rate reduction is the market expects something to break. And that means bonds and stocks and other risk assets and real estate and other sectors. So the market, regardless of what Powell says, is very nervous and betting against more rising rates because rising rates can go so high for so long until, as we've said over and over, something breaks. So many things are breaking. It's also important, again, without getting into the weeds of the minutia of bond spreads and bond markets, because I know that can make people's eyes roll over, but the yield on the 2-year was greater than 100 basis points during the week. You couldn't get a bid or an ask. You couldn't trade those at large volumes because there was too much volatility in the price. We haven't seen that since 1987. And frankly, it was worse than during 9/11. So 9/11, 1987, or 2008 were major crisis points in our life. Signature Valley or Silicon Valley Bank doesn't feel like 9/11, but the bond market is reacting not to Silicon Valley Bank, but it's reacting to too much stress. Major credit events. Powell has pushed these rates up. We can understand why. He's trying to fight inflation, et cetera, or whatever the optics are in that. We're trying to reduce the Fed's balance sheet. We're trying to kind of calm the years and years of QE. But the consequences, the markets are so addicted to that. And the consequences of that in the bond markets and in, of course, the banking markets, the regional banks are now, off the headlines. Things like the yield or the implied volatility of the 2-year Treasury don't make dinner conversations. They don't even make the headlines. But you have to understand that we haven't seen this type of volatility and this type of fear and this type of distrust and need for liquidity. It's worse than 9/11. It's worse than 2008. It's worse than 1987. So notwithstanding what isn't making the headlines, what's percolating beneath and below the ice of the bond market is a lot of distrust, a lack of faith. And I'll just say one more thing, Elijah, on the banking crisis that made the headlines. But again, underneath that banking crisis is really an economic crisis driven by a credit crisis. It's important to realize that why didn't, for example, Silicon Valley Bank or these other banks go to a discount dealer, a discount window, a repo market, try and get a loan against their collateral? They can take a haircut. They've got $100 million in collateral, get a $90 million emergency loan to avoid, liquidation or receivership. Why didn't that happen? You could argue it's mismanaged of the bank. The deeper issue is other banks or other dealers don't want a loan against the collateral because the collateral has less value. And in those loans that those banks held, the banks that were failing in the last 2 weeks and that will fail in the next 2 quarters, the real scary issue isn't bank runs or tech fears or ripple effects from Sam Bankman-Fried or Binance or lack of faith in the NASDAQ or the tech sector in Northern California. The real underlying issue is other banks, other dealers don't trust each other's collateral, just like they did in 2019 at the larger banks in the repo markets. And why don't they trust each other's loans and collateral? It's because they don't have faith in the economy. So it goes from, Powell, the Fed, big themes, the treasury markets, bank crisis, but it really comes down to a lack of confidence, a lack of faith in underlying loans, which has a lack of faith in the underlying economy. And so all these things are kind of connected, and they're really historical in their volatility and their historical and their distrust. And of course, the market is expecting a Powell pivot or at least a Powell pause sometime in 2023. You have to ask yourself, what does that mean? What, more quantitative easing, more liquidity, more on-demand synthetic liquidity? Well, that you can only achieve with massive amounts of inflation. There is no good scenario left. Powell can either pause or even continue. I don't think he'll raise this in the next quarter, but it's either, as we've said over and over in 2022, it's either squeeze the economy through a rate hike towards rubble and towards a recession and towards massive stress on the bond market, or it's pivot back to a system that failed since 2009, more quantitative easing, more mouse click money, more inflation. The Fed is cornered, Powell is cornered. Whatever you think of Powell, you could say it's heroic that he's trying to tighten what's been loose for years, but he really doesn't have many options. And so, the volatility in the bond market, extremely important, off the headlines. These are historical levels of volatility and distrust. And it really comes down to a cornered Fed and a lack of faith in the economy, a lack of faith in solutions.
Now, I know the issues are not just here in the U.S., they're abroad as well. I mean, where you guys are headquartered in Switzerland, we saw, Credit Suisse and UBS taking over Credit Suisse just a couple weeks ago over the weekend. Your perspective on that, what was the reasoning for that, and how has that shocked the country over there?
Yeah, it's a great point. I mean, long before SVB and Silvergate and First Republic and all these smaller U.S. banks were making the headlines, we've been talking about Deutsche Bank and Credit Suisse as zombie banks. They were insolvent, they were illiquid, and they really weren't. Their balance sheets were completely broken. So they had liquidity, solvency, and profitability issues, which were kind of historical in the last year, even prior to the the Silicon Valley Bank implosion, Credit Suisse wasn't even showing its cash flows. It wasn't publicly showing its cash flow statements because they were too embarrassing. And then, of course, I think the larger story behind Credit Suisse is much bigger than just, duration risk in their treasuries or their bonds. The larger problem was really New York-based investment banking side of that arm and their derivatives book. When rates go up, derivative contracts have to be delevered. They had a lot of counterparty risk. They had a lot of notional value risk. It's like the famous quote that, derivatives are just weapons of mass destruction, as Buffett called them. But the exposure and the counterparty risk and then the investment banking side of their balance sheet was so grotesque long before the small regional banks made the headline. The Credit Suisse was heading towards some type of emergency measure. The Saudis couldn't take another interest in it. The Saudis took a huge haircut. They didn't want to take more than 10% for regulation reasons. So as we saw, and this was reminiscent of 2008, as we saw in the U.S. with the too big to fail bailouts in the U.S. with some of the bigger banks that we all remember from 2008. Recently, the Swiss National Bank had to come in, UBS had to come in, just like JP Morgan had to come in and buy Bear Stearns, its pennies on the dollar. It was another bailout from the banks and from the central banks, but here a Swiss version of a much larger story we saw in 2008. But once again, it's banks behaving badly, their balance sheets, their solvency, their liquidity, completely at risk, and really, in a sense, too big to fail. Credit Suisse was too big to fail, but fail it did, and the cost of it, just like it was in 2008, does get passed on to the average citizen, because at the end of the day, when a central bank bails it out, that money comes from a mouse click, but it's also collateralized by government bonds, which are ultimately the responsibility of the citizens. So there's a lot of distrust in that. I don't think it's a uniquely Swiss problem. It's a banking problem. Credit Suisse is a banking problem, not a Swiss problem, but it happened to be in Switzerland. Again, many of the sins of Credit Suisse were originated in New York and the IB side and the investment banking side. But it's all the same sad story. Banks behaving badly, being bailed out by other banks and central banks. And I think what we're seeing now, Elijah, when you step back at 30,000 feet, the real narrative I see here is the failure of the smaller banks. The bigger banks were buying the good paper off those smaller banks and giving the bad paper to the public. We're seeing more and more consolidation from the smaller regional banks because they have so much duration risk. They don't have the diversification or the depth to stay alive in another credit stress. We're seeing a slow consolidation towards bigger banks, but the ultimate consolidation, the ultimate end game, I think here is central bank centralization of these economies in the US and in Europe. And of course, central bank digital currency is just a symptom of that. But keep in mind, and historically, the last time we saw a nation whose entire banking system was through one centralized bank, which is the slow evolution, was the Soviet Union. So this is not capitalism, what we're seeing. This is bailouts, bail-ins, covert, overt, too big to fail narratives. We're all getting kind of tired of those. But the end game of more centralized control and central bank centralization is antithetical to all the things that capitalism stood for, all the things that banking stood for. It was the reason why Thomas Jefferson and Andrew Jackson and others warned against this, or Ludwig von Mises warned against these type of centralized controls, because eventually what you have is a central bank actively managing the economy, actively managing the markets like it's their portfolio. And if you don't trust that central bank, or if it gets stuck in a corner like it is now, you lose all the liberties of normal price discovery, normal banking, normal risk. And of course, the only way they can bail these things out is through money that doesn't exist in productivity, tax receipts, GDP. It's going to come through a mouse click, which destroys our currencies. Great tailwind for gold, but an immense headwind towards capitalism, towards free market price discovery, and towards the average citizen, because the invisible tax of inflation is what hits the main street the hardest and the middle class the hardest. And unfortunately, the Fed really isn't worried about that right now, despite optics to the contrary.
I think inflation is one thing that is hitting people right now and they can see, right? Did you want to kind of walk us through some of the other risks that people have if they just hold money in the bank, right? Obviously, we need some liquidity just to pay the bills day to day and to have some sort of emergency fund there. But your perspective on because a lot of people are concerned right now about the safety of their money in the bank. Do you think that's a legitimate concern right now? And if so, what are the risks right now for people who just have a lot of money in the bank?
Yeah, it's a great point too. I mean, first of all, there is the standard FDIC insurance, right? If you have less than 250, well, there's less concern there because it's automatically insured. What we saw with SVB is the FDIC had an emergency exemption. So they raised the FDIC cap, but that really wasn't what would solve or save the depositors. It would ultimately come from the central bank and the Treasury and these emergency funds they have, which frankly wouldn't be enough if every small bank had to run at the same time. What we saw, the response from the U.S. Treasury and the FDIC, which I understand was realistic, they had to alleviate that fear immediately of a bank-run contagion because if all the small banks at the same time had the same fears and depositors ran, that would be way too expensive and way too painful. So what the Treasury and the Fed and the FDIC did very quickly was try to contain the psychological fear of a spread by effectively bailing out the depositors, not saving SVB, but bailing out the depositors. The question is, can they do that at a global level if all depositors have fear at the same time? And the simple answer is they couldn't. That would cost trillions, and that would require a great deal of instant mouse click money, which would be inherently deflationary. So to answer your question, even small banks at this stage would be too big to fail as well, because there would be a complete lack of confidence in the banking system. So they've done a very good job at not only controlling the money but controlling the narrative. And for now, there's a calm. To your question, what can individuals do? I've known people from Texas to New York who have far more than 250,000 in banks, so they spread their deposits in different banks. You see that. They make a phone call, they make a transfer. That's one way. The other way is to, of course, get it out of the banking system into real assets or other accounts, or even, frankly, into money markets. And that's a big issue because you can get a better yield in the money markets right now, thanks to Powell, than you can get it as a deposit on a deposit, a checking account or savings account at a bank near you. And that was another major fear. If the depositors just ran to money markets, thanks to Powell's interest rate policies, there's better yield now in these short duration treasuries and in bills and notes and bonds. And so there was a flow into the money markets, and they want to avoid that going too far to the point where it's detrimental to the smaller banks. So there's a real fine balance between keeping people in their accounts and not going to the money markets. And so, but I certainly talked to a lot of bankers last week. This massive amount of client demand to put money into money markets. It didn't mean they were pulling out their deposits. And for now, I think there's been a temporary détente or a temporary peace over the rubble of those banks. And there's a little more confidence. And frankly, not a lot of headlines are trying to stay calm, carry on, not talk about it. But the first thing is, yes, you can diversify into other accounts. You can diversify into money markets. It's hard to just pull your money out of every bank and put it under a mattress. There's all kinds of risks with that. I think other things that individual investors now who are worried not only about their banking systems, they have to worry about their portfolios too. And I'm not just talking about real assets like gold and silver, but many people have RIAs or directed accounts, retirement accounts, pension plans that are primarily 60-40, 70-30 bond stock portfolios, which again, we've talked about in the past. Taking my gold hat off or precious metal or commodity hat off and just looking at my old hedge fund thoughts, these portfolios, as I've worn for over a year, are highly risky because stocks and bonds no longer hedge each other. They correlate. And so I think you need to talk to your advisor, talk to your portfolio managers about standard traditional portfolios. I think those are very dangerous. And of course, most importantly, and this is not a gold bug comment, it doesn't mean just precious metals, but you have to look at cycles and you have to think as an investor, not a trader. You have to look long term. There's a great chart that Ronnie Sturfla came out with a couple of weeks ago. And he said, is this the most important chart of the decade? And really what it is when markets crash, commodities in general as an asset class rip to all-time highs. And we're at the very bottom of a commodity super cycle right now. Again, if you're not thinking next week, next day, next month, but thinking longer term protection of your wealth, it's a no-brainer that commodities are going to rise and that risk assets are going to fall. So you have to think globally about going out of the stock bond mentality into the real asset mentality. That's not just precious metals. It's non-monetary metals as well, or other commodities. Those are going to have a secular, I think, bull run over the next many years. And that will be a good hedge against banking risk, portfolio risk, and currency risk as well, not just silver and gold. Clearly, I have a bias towards monetary metals, in particular towards gold. And that is based on objective conviction. And it's a no-brainer. And gold, as we've seen, has risen particularly because gold loves chaos, but more importantly, gold doesn't rise, currencies just fall. In the US dollar, as we said all of last year, the strength of the dollar, the relative strength of the dollar was entirely temporary. It was based on rising rates. At some point, that policy is going to bend and break. It's already broken everything else. Remember, stock and bonds in last year's nominal returns were the worst since 1871. So everything is breaking. Regional banks, risk assets, faith in these underlying loans of these banks, and faith in the overall economy is all kind of converging now in a perfect storm. It's not sensational. It's just the hard math of this. I think if you look at the commodity cycle, everyone says they buy low and sell high. Very few people do it. It's hard to get away from consensus think. It's hard to break away from the pack. It has to be intelligent contrarianism, rational contrarianism. But the next cycle is away from risk assets and into commodities. I'm not, again, just speaking about precious metals. I'm talking about the commodity sectors. There's some fantastic graphics on that. Again, it's thinking longer term, Elijah.
As we're looking right now at people rushing into precious metals, it seems like, especially on the retail side, your perspective on that, because it seems like there's been, unprecedented demand for precious metals and people getting out of the system, but this is just a tiny portion of the public moving in. What happens? What is your expectation for the future then, if more of the general public starts moving into metals?
Well, remember, it's 0.5% of all assets are held in gold. I mean, it's a small sliver of the total asset categories and choices and sectors for investors. And there's a reason. I mean, it's not cynical. Gold, like Bitcoin, is an existential threat to the U.S. dollar. It's not talked about in the major journals. It's not talked about the banks. It's not held by a lot of the banks because they can't create prop tests for it. They can create legalized price discovery on the COMEX and the OTC market to force the price down. But there's not a lot of profit in gold. It can't be churned and fee structured in a way that makes banks profitable, so they ignore it. But as more people become aware of it, and believe me, without disclosing names or disclosing amounts, our organization deals with high net worth clients. It's significant amounts of inflows all the time, low price, high price. To them, it was always insurance against currency risk and banking risk. And now they're being proven correct. A lot of new investors are coming into the space because they're getting price confirmation. They're not thinking based on an intellectual, historical, mathematical way. They're just looking at a trend and thinking, I got to get on. If you understand the historical role of gold, the commonsensical role of gold, the flows of gold, also, if you just look at the stock to flow ratio, gold has a finite supply. It's only a certain percentage a year in the supply exchanges. So it's a very finite supply of a monetary metal that has an infinite duration. It makes perfect sense. And yet people don't see that until the price proves that it's true. Well, again, gold will go up because currencies mathematically have nowhere to go but down. They've been going nowhere but down against gold since 1971 when we closed the gold window. But I think it's human nature, it's psychology. You wait to be proven right when the price is right. But even at these prices, gold is still an incredibly good price. Even at these prices, they're higher than they were at their lows just a year ago in the 1600s. Now they're in the 1900s. But even these prices, as you look longer term, they commonsensically, historically, 1900, 2000, 2100 will still be a very good value. When you look at gold for the right reason, as wealth insurance, wealth preservation, and just like we have home insurance, life insurance, car insurance, house insurance, it's just insurance against currencies that are openly dying, including the dollar now. Especially, we can talk about de-dollarization, but you have to think more than 5 weeks ahead, 5 minutes ahead. It's not a smug moment of I told you so. Gold can have volatility from this point on. It can go up or down. Its trend is clearly north, like the commodities in general. I think people have to, when they have conviction of why they have gold, it's no longer a question of daily price, and they should be buying whenever they can, not just when the price confirms it. In the end, gold does get the laughs laughed. It's not a smug gold commentary from an executive in Zurich. It's just common historical sense. And so, yeah, unfortunately, people do tend to wait to buy when the prices are high rather than low. But right now, it's certainly a good buying opportunity, and I say that objectively.
What is telling you right now that the price is not too high right now? Because we have seen quite a run up in the last couple of weeks since this whole banking crisis started.
No, I mean, this is something that becomes amorphous and opaque. It's really about faith in the system. And how do you quantify or measure faith? How do you measure confidence in your politics, measure confidence in your society, measure confidence in your currency, and in your central bankers. And again, it's palpable wherever you live in the US and including Europe. There's a lot of fracturing. And, gold does love chaos. And this is all coming back to that four-letter word of debt. There's throughout history, whether it's just prior to Chairman Mao or prior to the rise of Franco, Mussolini, and Hitler in the 30s, or whether it was prior to Napoleon in the 1790s, inflation always leads to social unrest. It always leads to financial crisis. And it always leads to more control. And that social unrest component of it, again, throughout history, there's no exception to this. That social unrest is usually based on inflation, which means you're feeling poorer. You're feeling more stress, not just the inherent purchasing power of your currency, but you're worried if you're going to be employed next month. You're worried if you're going to be able to make a mortgage payment. You're worried about a car payment. You're worried about tuition. That creates stress. And that means a loss of faith. And eventually, that leads not only to more centralized control from the left or the right in power, but eventually there's a loss of faith in the currency. And that becomes very scary. And so you look for solutions. And that's why people start looking to gold, And I think whether the price is definitely going to get higher, to me, it's just a question of the currencies are going to get weaker. There's no way around it, because ultimately the Fed will do. The currency is always the last bubble to pop. I've written about this over and over throughout history and throughout cycles. The currencies are always the last bubble to pop. But people are asking, when is the Fed going to pivot? They didn't pivot after SVB. When are they going to pivot? Or when are they going to pause? It really doesn't matter whether it's, this week or this month or this quarter. They have to. They will. Because what will really create a pivot won't necessarily be a bank failure in Northern California. What will create a pivot is when we see another moment like March of 2020 or September of 2008, when you see a real contagion, a real uh-oh moment in the broader markets. The Fed doesn't want to see a contagion. They don't mind downturns or drawdowns. They're very afraid of contagion, loss of faith. So they will have to create more liquidity at an instant, like they did in March of 2020. We saw more money printing in the next 12 months after that than we did in the prior 10 years. And that was an extreme scenario. But as I've said, the markets are already pricing in some uh-oh moment this year. Something's going to break again, bigger than SVB. I don't know what that will be. It will probably be another disinflationary tailwind, a massive disinflationary moment in the broader markets. At that point, they will sacrifice the currency to support the bond markets in particular, which indirectly supports the stock market. Don't ask me what day that'll be or what month that will be, but it is inevitable. There's too much stress. There's not enough natural demand for these bonds. There's not enough natural demand to keep yields and rates naturally down. There will be a moment of mass liquidity, which means massive mouse click money, which is massively inflationary. And the dollar will go back to where it belongs, like all the other currencies that are dying on a trend south. That's when gold will really rip in price. And again, it's ripping in price when measured in dollars, euros, pounds, yen, whatever. It doesn't mean, again, that gold gets stronger. It's just that currencies get weaker. And if gold's at 2,600, we can certainly be glad, because that's maintain our purchasing power, but the cost of a loaf of bread or a pair of shoes is going to be significantly higher as well. So it all balances out. Gold rises because currency's inherent purchasing power fall. And to your question, they will pivot when something really breaks, bigger than SVB. That's just another symptom, not in and of itself the only symptom. It's so many. And when markets break and when confidence breaks, they're going to try and buy that confidence, like they've bought votes and bought time by printing more money to quote unquote support the markets. Unfortunately, the vast majority who benefit from the stock market are the top 10%. 90% of the population won't be helped by that. And so you're going to see more social unrest, more distrust, more confusion. Not everyone has to understand central bank policy or bond spreads or yields or 10 years versus 2 years or inversions versus de-inversions, but everyone feels inflation. And no matter how sophisticated or unsophisticated you are, when the Main Street consumer just can't afford to live on the salaries they have, or the salaries they're losing, or the jobs they're losing, and the dollar in their pocket doesn't help them anymore, that's when you have real problems. And that's when gold, sadly, for the world goes up, and fantastic for those who invested in it.
Before we let you go, Matthew, where can our viewers find you online? And did you have any last thoughts for our viewers?
Yeah, online it's very simple, goldswitzerland.com. We're based out of Zurich, so it's Gold Switzerland. And we have a lot of articles that track the bond market, obviously, but these other larger questions about malfeasance at central banks. And, to your point, when we had Bretton Woods at the end of World War II, America was a different country, a stronger country. It just saved Europe. We had a lot of faith in us. We had a currency at the time that was gold backed. The world decided to make the US dollar the world reserve currency because it was gold backed, but we welched on that in 1971 under Nixon. So we didn't keep our promises. We didn't stay with sound money. And that was 50 years ago. And so this process is slow and steady, but my final thoughts are, America has lived on borrowed time, a lot of borrowed time with a dollar that wasn't chaperoned with some real asset, with real faith in something real. The full faith and trust of the US government no longer carries the kind of weight that a gram or ounce or kilo of gold does. It's simple common sense. And so I think the more we can spread the word in the US, Europe, South America, anywhere about the importance while you can to purchase gold. We have many clients, whether they were from Yugoslavia or Venezuela, when their countries were ruined, they were saved because they bought gold. Don't think that America is immune from those same forces just because it's America. We're not predicting the end. I'm not predicting the end of the US dollar as a world reserve currency or the end of America as a country, but I'm predicting the end of an era. And in fact, I'm not even predicting that. It's already happening. We all know that. It's already happening. And we could talk next time about de-dollarization, the flows east, the new trade agreements, bilateral trade agreements, the petrodollar, the petro-yuan, everything's moving away from the dollar. That's slow at first and then very fast. And that's happening in real time too. So there's a lot converging right now, way more than we could talk about in 30 minutes. But again, we don't have to apologize as gold bugs anymore. We're just trying to give high conviction common sense.
Fantastic. Matthew, once again, thank you so much for your time and God bless.
Thank you, Elijah. It's always a pleasure.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.